Hi friends, I'm back with part 2 of Debit Spread. If you look back at the part 1, we have discussed about all these bullet points. So there were like few points which I've missed in part 1, so I thought of making a part 2 for the debit spread. All right. Last time when we discussed, when I said the debit spread is combo of one buy and one sell, so it can be deployed on both CE and also on the PE side. So last time we entirely took an example of only for the CE, that is the bullish market. The same thing can be applied on the PE side. So in case if you feel like if you have the market view as a bearish, you can just go for the PE side, PE debit spread, which is like the bearish. So I thought of covering these points. So somehow I missed out in the part one. So let's cover this in the part two. We'll discuss about the capital requirement for for the debit spread, and then we will go for profit and loss. So what will be the profit and loss for the entire debit spread versus if you go for equity or futures. The third point would be how to deploy the debit spread in line to the chart analysis, or it could be open through the open interest. And last point, we will discuss about T plus zero and the expiry using Obstra or Sensible, how to know the profit and loss on T plus zero and how to know the profit and loss on the expiry. Capital requirement. So this time, friends, we'll use Obstra. All right. Last time we have used the Sensible, so let me use the Obstra today. But this would be like very easy for me to show you in the Obstra because the percentage, the profit percentage calculations are given in the Obstra, but this is missing in the Sensible. All right. I've taken the same example, friends. 37,600 was my bought and 38,100. This is a called debit spread. Okay. If you look at the capital requirement, this basically requires 18,570. So this would require like somewhere between 18,000 and 20,000. Though we are buying and selling, but the capital requirement for this debit spread would be like only 20,000. Okay. Right. 20,000 is the capital. And then we go for profit and loss of debit spread. Okay. So when you look at the profit, it has the potential of almost 50% on a capital of 18,574, and in line to the profit, you have the loss of 17,000. Sorry, 17 percent loss on the capital deployed. All right. If you look at the max ratio, it has 1:3, almost 1:3. But friends, don't you feel like on 18,000 or 19,000 of the capital, 60% of the profit within a week? That is like the expiry is on the 7th. So don't you think it's a huge return? So just assume if you went for equity or for some futures. So will you be getting this percentage? What I mean to say is if you look at this payoff graph, right, to get the maximum profit, let's say your market is standing somewhere around 37,192. So let's say on the expiry, if your sold positions becomes in the money, if you look at the green color box right on the left hand side, it says change from spot, that is 2.74%. If market goes 2.74%, you will get 9,222. So friends, let me make your job easy. Rather than going for the index, so this is like for the bank Nifty index. So let me take an example of stock, FNO stock. All right, so this would give you like more clarity. So I've deployed a debit spread in TCS, right? I've taken a OTM. I've bought a OTM of 85.2 rupees premium, and then I sold 3920C for 44%, for 44 premium. Right? The same debit spread, the same logic, but this is for the FNO stock, not the index. All right. So if you look at the profit percentage, 60% on a capital of 1970 735, and then almost 30% loss on the capital deployed. All right. This is where the market stands. The market stands at 3769. So let's say in 1 or 2 days, expiry would be like 28, friends. So for the FNO stocks, we have the expiry for 28, not the weekly expiry. All right. So let's assume that your market goes up, or else your sold position, this position 39,200. becomes in the money, meaning the market reaches your sold position. So if you look at the left side, right, it says change from spot, right? From spot, if market makes a move of 4.55% on the upside, friends, you will get 60% profit on the capital deployed. All right. In line to that, if your market makes a downside move, so you will have the loss of 30%. So anyways, we have all the adjustments for the loss making trade, how to minimize this loss or else how to make zero. And if you have like bigger capital, you can also come with some profit. So wait for my adjustments video, but I wanted to show you the difference between the maximum profit for the debit spreads versus the equity. So let's say, friend, you have taken a normal equity investments in TCS, right? So let's say you have taken the shares worth 19,735 in the equity. What I mean to say is this part. Forget about the debit spread. You're planning to take a equity or the future cash segment, right? Do you think if market makes a move of 4.76, will you get the profit of 60 percentage? No, right? So you'll get the profit worth only 4.55%. So this is the beauty of the debit spread. With the market view of only 4.68 or 4.5%, you end up getting 60% on the capital deployed. So this is the beauty of debit spread, but there is a catch, friend. So you need to be like very much aware of the market view. So if you are very good at plotting the support resistance, or if you're very good at price action in terms of identifying the market move, all right, so this strategy, this debit spread would end up giving a good potential profit, 60% on the capital deployed within a month of time. But if you deploy the same thing in the equity to get this 60%, market has to move 60%. But in the debit spread, even if the market moves to 4.47%, on the expiry you get 60% of the profit. So hope, friends, I was very much clear in terms of explaining you the potential of the profit and also loss in the debit spread with a combo of one buy and one sell, and also when you go purchase the stocks or futures. All right, but there is a risk also, wherein you will be like losing 30%, but this we will discuss about all the adjustments, how to make this zero or to very minimal, or even at times we can just come up with the profit. So wait for my adjustment videos, friends. All right, so let me take you to the slide. So we have discussed about the capital requirement. We have also discussed about the profit and loss versus debit spread versus your equity and futures. This one is very important, deploying the debit spread in line to the chart analysis and OA. What do I mean? So let me take you to trading view. All right, this is a 30 minutes chart. So let's assume this is like during the market hours, your price is standing somewhere 37 to 36. So let's say you have the market view of bullish, you have the market view saying that maybe market will bounce back from here, or it will go until this resistance that is like almost 38,100. All right. So what did I say? So whenever we go for the debit spread, we do not deploy the debit spread at the ATM, because we end up getting only 1:1 risk to reward. So just to ensure that we get 1:2 or 1:3, the best selection criteria for the premium or your strike would be, you have to just go like 2 to 300 points OTM. You buy one leg, that is like 37,600, and let's say this is your resistance. So based on the previous price action, so let's say this acts as a very good resistance level. So maybe you have the view of market going up, but market would not resist, or market would not break this resistance, it might come down here. So I think this is the best potential trade for you to go for the call debit spreads. So what we will do, right? So we will buy the 37,600 and 38,100. All right, so that's what I've done, friends, here, right? 37,600 I bought one C leg, and then 38,100. Okay, the same thing. The moment we do this, see the risk to reward, right? It's almost 1:2, right? Sorry. Yeah, this was so 37 600 and 38 100. The risk to reward is almost 1 is to 3. So do the option say 1 is to 2.81. So let's assume this as 1 is to 3. All right, let me go back to this slide. Okay, so this is basic. See, rather than just going through the premiums, if you have a very strong knowledge on the price action, if you can just start plotting this support, right, this would be your buy leg and this is your resistance, right, so that would basically help you in terms of selecting the right strikes and coming up with the right risks to reward, right. So you have almost like 1 is to 3. All right, let me go back to the yeah. So let's say your market stands here, and if your market keeps moving, this is your buy leg. Right? The moment the market reaches here, you'll end up into some smaller profit. Let's say the market keeps increasing. I mean, sorry, going up, and it touches your selling point. So this is the area wherein you will get like maximum profit. And even if the market makes a move of another like 200 to 300 points above your sell points, so your maximum profit is locked. I think you are aware of this thing, right? So your maximum profit is only 9,222. Even if your market makes a move of like 300, 400 points above the selling point, your maximum profit is locked. At the same time, even your maximum loss is capped. All right. So let's take the other example. This was the market went as per your view. So let's say on Monday when the market starts, the market made a move and the market comes down and it comes down. I mean, it takes a support, right? If it takes a support, you can just stay in the trade, friends. I mean, market is supreme. It is not something like market will go in one direction. So it will go up. It will retrace. It might take support at this support line, and then if you find any candlestick pattern, or if you find some open interest on the put side, there is a strong put writing. So then you can wait for like 1 or 2 days. But just in case, right? Just in case if the market comes down, if it breaks your support, if retest and if it comes down, so friends, then you need to just think about the adjustments, because your view went wrong here. So you thought market would go up, but that has breached your support. So now you have to just go back to your adjustments, and now you have to just think about how to mitigate your loss. All right, because your view went wrong, so you cannot again be with the same view saying that market would go up, but now you have to just go back to your trade and try to do all the feasible adjustments and mitigate your loss. All right. Yeah, so there is one more point, friends. This is like t plus 0 and the expiry, so this is in line to your profit and loss. Let me take you back to the trade. All right, so do you see this blue line, friends? Do you see this blue line? So this is t plus 0. T plus 0 is the current day. So let's say your market moves like 1%, or maybe let's say your market makes a move of 37,942 on Monday, right? Keep an eye on the two boxes, the green one and the blue one. The blue one says t plus 0. So if market makes a move of 2.1%, check at the green side, it says change from spot. So from the current market price, market has made a move of 2.1% on Monday. I'm not talking about the expiry, on Monday, right? Your profit would be 3,633 on Monday, because that's not the expiry. If you look at the top box, it says 4972. So that would be your profit on the expiry day. So friends, this is very important in terms of understanding your profit and loss based on where do you stand close to the expiry. All right. So t plus 0 is the current day, and the green box, it clearly says that's for the expiry, right? To get, let's say on Monday, right, your expiry is on 7th, but let's say market comes somewhere, market makes a move of 9 dot almost like 10%, right? So that would not happen, but let's assume we have an upper circuit. If you look at the blue line, right, if you look at the blue line, you will get into complete full 49% of profit. So look at the green and the blue box. it's almost same. So t plus 0 on the current day, you'll make a profit of 9,200. That is almost your 50%, right? Even on the expiry, if the price ends somewhere here, anyways, you're going to make the full profit. But just try to get the difference, friends. So what I mean to say is like this blue line is like t plus 0. So let's, if market opens gaps up with the upper circuit of 10% or 11%, you will end up into getting into full profit. So this is the difference between the blue line, right, and your expiry. So this blue lines actually keeps moving as and when we get closer to the expiry. All right, let me take you. I think we have covered almost the remaining topics, like what is the capital requirement, right? What is the profit and loss of debit spread versus your equity and futures. All right, deploying the debit spread in line to the chart analysis and OA, friends, this is important. If you have a good grip on identifying the trend of the market through chart analysis, or let's say you're using some indicators, or you have some typical trade setup, and in support of the open interest of, if you can just identify the market trend, I think going with the debit spread would be the ultimate option. Right, you saw the profit and loss, the potential profit and loss, and even in case if the market comes down, you can just uh, mitigate your loss by the adjustments. So friends, I wanted to take you one more time. So these are all the adjustments. I mean, there is no end for the adjustments. For basically, these are like 8 to 9 adjustments. I wanted to add like few more. So as and when I deploy the trades, I come across all the adjustments. I'll ensure that I'll keep adding. And believe me, friends, I'm just coming up with another 8 videos on these different adjustments. I'll try to take Obstra or Sensible. I'll take up a very good example. Right, I'll try to do the back testing within the Obstra or Sensible. So these are all the required adjustments. So keep waiting for my friend for my video. So I might be making this video in another 1 week. I think it takes time, friends, but I need some sort of motivation from you all, guys. So please subscribe my channel, and if required, just share with your friends. Thank you, friends.